We are super excited today to have Jeff with us. Jeff is the founder of Uncork VC, one of the OG institutional seed investors of our time. So I'm going to turn it over to Anamitra to share a little bit more about the Angel to Fund Manager series in general. But while I do that, I want to let you guys know that Anamitra will have some questions for Jeff, but please use the Q&A feature once we get started to feel free and submit your questions to Jeff as well. Anamitra, over to you.
Thank you so much, Laura. Welcome everybody who's joining us today. I just wanted to sort of, before I properly welcome Jeff, I just wanted to sort of lay out why we're doing this event. This is part of our final week of the Angel to Fund Manager program at Afore Capital, where we were fortunate enough to work alongside 40-ish or so very early stage fund managers who are beginning their journey on towards raising their very first fund. And as founders know who are starting companies, fundraising is one of the hardest things that they can do. And it's especially hard when you're raising a fund because you're not looking for one lead, but you're looking for multiple leads. And then on top of that, if you're raising money for the very first time for a fund in a crowded market, it's even harder. So we created this program over a 6-week period where we had eminent speakers come in and talk about things like differentiation, branding, portfolio construction, fundraising tactics. And we wanted to cap off this week, starting with Jeff, to talk about what it was like when they first started. This is the final week of the program, and we're super psyched to have Jeff, specifically because he was one of the key people who sort of institutionalized seed funds. He went through the hero's journey of going from an angel to a super angel, now to an institutional fund that every LP wants to be a part of. So in welcoming Jeff, it'd be wonderful if Jeff, if you could give a little bit of a background about your story, and particularly how you started off in VC.
Sure. And first, thank you so much, Anamitra and Laura, for having me. It's awesome that you're organizing, this kind of program. I wish that existed way back when. Could have been useful for me. So start by the beginning. Born, raised, educated in France. Did a startup in the financial services market. We brought sun workstations to trading floors when green screen TVs were replaced by actual sort of digital information on a PC. Company was fairly successful. We got acquired by Reuters. It was Reuters versus Bloomberg at the time. And as the CTO of the company, I just stayed, around at Reuters for about 7 years and was in charge of a bunch of different things. Large projects where I had hundreds of developers working for me. And in 2000, after the millennium and the Euro transition and the millennium, I was approached by the guys running the Reuters Greenhouse Fund, which was the corporate venture arm of Reuters, to join them as a partner in the Valley. So I moved to Silicon Valley in August of 2000, became a VC then. Worst time ever in terms of becoming a VC, because it was an absolute nightmare. And I spent 4 years basically, managing the mess that my partners had created for us, and started seeing this emergence of, entrepreneurs building this next generation of web solutions. We called them Web 2.0 at the time. And what was interesting was that they were really sort of capital efficient. They were looking for a few $100,000 to get going, and there was not really a product in the market. You had angels and you had VCs, and people were writing small checks or large checks, but there was not something around in the middle for medium-sized checks. And so started SoftTech at the time, now Uncork, in 2004, because I wasn't foolish enough to try and raise. I spent 3.5 years being an angel, then a super angel, so investing my own capital. We had made a little bit of money at Reuters, and so my initial fund, if you want, was $250,000. That's what my wife and I had agreed in terms of taking money away from our savings to invest in early stage startups. And it worked out, went really well. Invested in Mint and a few other iconic sort of companies. And then in 2007, I started having people sort of come to me and say, hey, do you want to invest our money? Like, here is some cash because you've been successful. Why don't you, work with us on that? And I basically decided to raise a fund because I could, right? And so in the summer of 2007, in about 8 weeks, I gathered, 12 and then, $15 million for our first fund, which we called Fund 2. And everybody was sort of laughing about it because, what was someone with a $15 million fund going to do against, VC that had hundreds of millions of dollars? And when the 2008 crisis sort of kicked in, it wasn't clear that we and our companies were going to survive, but we did. And eventually we raised, a lot more funds now, 13 years later or 16 years after starting. We've raised $500 million. We're on Fund 6, which is still a seed fund, $100 million. We also have a growth fund, opportunity fund called Plus, that is 100 million. And we've invested in 238 companies.
Right. One of the challenges, as you mentioned, for first-time fund managers is to raise the first fund, is to because very few, especially nowadays where there is so much competition, LPs have so many options. Just getting initial LPs is pretty hard. What advice would you give folks who are getting initial LPs to invest in their first fund? Because they may not have the luxury of thinking, will this LP support my second and third fund? I just need to get off the ground with the first fund. And then if my performance is good, hopefully they'll come back. Based on your learnings, what advice would you give folks who are thinking through the initial batch of LPs for their first fund? How should they think about which LPs to bring on board?
It's a great question. Unfortunately, at the beginning, unless you have a stellar, track record as an executive or an angel or both, you won't be sort of a hot commodity, right? The good news for, new managers is that there have been, Manu Kumars and Chris Sakas out there that have generated spectacular performances out of their first small funds. And every LP has that in mind, because Saka had a miserable time, raising his first fund, which is the most successful fund in history, I think, probably, with 250x. And, every LP that met him just remembers that they could have been that one, $500,000 or $2 million check, which is what Industry Ventures sort of did in the $8 million fund. So it's a balance between get the fund raised as you can, and take the money you can, and think about longevity, but in the early days, take the money that is willing to invest behind you, and start building relationships. That's the one thing which I didn't do at all. Start building relationships with LPs ahead of fundraising. Like, I was I was on my own for 6 years, right? So I was very binary. I was either in fundraising for the fund and I was spending time with LPs, or I wasn't, fundraising and I wasn't talking to LPs at all. This is a huge, huge mistake, right? You want to sort of engage with the LPs, and whenever, you feel that there is a connection, you may not sort of get them for Fund 1 or Fund 2, but you may actually get them in Fund 3, right? Because some LPs will not touch you until you're in Fund 3. Some LPs won't touch you until you're in Fund 5, right? And you have to understand that and build this sort of pipeline and communicate with LPs and meet with them outside of your fundraising cycle, so that you can actually activate those relationships when you're actually sort of fundraising. Because LPs are not like us VCs. They're not like churning on a relationship saying, oh, I've never met you, but now I'm going to give you money, right? This is not the way they think. They're like, I'm going to spend time with you. I'm going to get to know you. And then, for this fund or the next fund, then maybe, in 2 or 5 years from now, we'll sort of get in business together, right?
Makes sense.
And so that's something that you want to think about. But first fund, raise it as you can. Just understand that if everyone disappears, it's going to be the same misery raising Fund 2. That's all.
Makes sense. We have a question related to this from Uncork. The question he's asking is, once you lost that anchor, you were still able to do the first close. How did you communicate that to the remainder of folks who are looking to see an anchor who's going to participate or not? They want to be part of they don't want to be the last. They want the first close to be as large as possible. And so they get antsy. How were you able to sort of give them comfort?
So I was lucky that the people who came in the first close, besides the anchor that disappeared, were, people who didn't need validation from other firms or funds or whatever. And when I called them and said, this is what's happening, they felt bad about the fact that I lost, a bunch of my, basically, 20% of my fund in one go, 3 days before Christmas. But they were convinced that, this was still sort of a good investment. And I got lucky that no one got scared and said, oh, no, I'm not going to close. And, once I got, so AMG National was $3 million, I think. Industry Ventures was $2 or $3 million. Thomson Reuters, my former firm, was $3 million. And all those guys sort of said, okay, we'll just go ahead. And that was enough of the close that the rest of the investors were not afraid of committing. And so I'm lucky that, the guys basically believed in me and said yes. They could have said no.
Well, Jeff, first of all, thank you so much for being so open and transparent. Most folks who kind of make it don't talk about things that are tough with this kind of detail, especially going through some hard times. So first of all, thank you. I think everyone is going through this process kind of really relates to that. One thing that is pretty common nowadays is a lot of Series A funds have today they have scout programs. Many of them even have fund of funds investing in a lot of emerging funds. How were you able to build those early relationships with Sequoia and Norwest? Was it folks you already knew? Do you think that what you were able to do back then is is more sort of commonplace nowadays? More folks are doing that because because they want deal flow? Is that would you recommend that from folks today who are raising funds?
Yeah, I think it's essentially Series A firms, and at the time, they were, these guys were not investing at seed. They were just waiting for opportunities to come to them, at Series A. And so Tim Chang, who's now a managing, partner at Mayfield, was a principal at Norwest, and I was, spending a lot of time in San Francisco, hanging out, with entrepreneurs. That's how I was getting my deal flow. So my poor wife didn't see me for a bunch of years because I was in San Francisco or hanging out somewhere, pretty much every night. Tim essentially sort of said, hey, we'd love to put in place something more systematic where we can see your deal flow and invest behind you. And I was like, well, I can share with you the kinds of opportunities which I'm investing in. And that's what I was doing. Because remember, what we were doing wasn't sort of super obvious. And so it's not like today where, if I have a series of opportunity, I know it's going to be funded. I'm not sure by whom, but I know it's going to be funded. At the time, it was really sort of challenging to build that bridge to Series A. And so what I was doing is I was spending a bunch of time with GPs of the best firms to hang out with them and say, hey, this company is sort of coming around, this one, and I was facilitating the discussions with the Series A firms like Sequoia that did the series of Eventbrite and things like that. And so the relationship turned into this discussion about, hey, why don't you raise a fund? And to be candid, Tim actually, so this is the one who said, hey, if ever you were raising a fund, I may be interested in getting Norwest to anchor it. And that's what triggered the idea of, hey, maybe it's actually sort of time to do this, because I didn't want to spend a year or two trying to raise the first fund, because that would have been literally, a misery. And I don't think I had enough of a track record at the time. And so this anchor check or this anchor check opportunity that Tim sort of created for me was really fundamental.
Got it. Makes sense. One of the other things that a lot of fund managers do, and LPs would like, is sweeteners as part of participating in the fund or committing to the fund. It could be in the form of carry, a break on fees, co-investment rights. What do you think about what do you think about these sort of special treatment for LPs? What in your mind is totally okay? Where would you draw the line yourself? What kind of recommendation or advice would you give for folks who are just starting off?
So it's very common that the first anchor LP tries to get a pound of flesh from you, and my advice is just avoid it as much as possible. Like, don't give a break on fees, don't give a piece of the management company, don't give anything, carry. And I know it's hard to resist the temptation because it makes your life so much easier once you have like a committed anchor. But the problem is that no one accepts that it's just for the first investor, because it's like, oh, I'm the second investor, I'm as important as the first investor, or I'm in the first close, I want the same thing. And then before you know it, you've given up so many parts of your economic package that it's not even sort of worth being a VC anymore. And so I was lucky, like I made the rules very clear, and I was foolish enough to say, well, look, I'm a successful angel, I don't need to raise this fund, so it's going to be raised on my terms or I won't do it. And it's crazy, but it worked, right? And same thing happened with Fund 3, where I said, those are my terms. And they were, pretty GP friendly. And over time, you build on, because it's very hard to undo things that you had in your LPA. Because typically when you have an LPA for the next fund, it's your previous LPA in red lines, right? And so any modification they sort of look at because they want to see how you change your terms. And so anything you give in, you're going to have to explain to the next set of LPs why you're no longer giving it in. And so this is a multi-fund, legacy that you don't want to have.
That's a really important point, Jeff, which is you may be fund one GPs may feel like you just you kind of give on a bunch of things on the LPA, but what many folks don't realize is that for the next fund or the fund after that, the fund one LPA is the baseline, and it's you can't really go back on a bunch of things. It's just minor tweaks and improvements for subsequent fundraisers, because it gets written in stone in a way.
Yeah. And when you get to Fund 5, you basically say, hey, there's always like a set of languages that are sort of altered because the laws evolve and so on and so forth. I think in Fund 6 we introduced the notion of digital currency as being something we can invest in, but we barely made a change over the last couple of funds. And LPs like that. And if it's terms which are in your favor, you just say, well, they're in the LPA. Like, I'm not going to change that. Like, would you do this or that? I said, no, because it's not in the LPA.
Got it. Makes sense. And one of the things you mentioned is that you began to build relationships with LPs in between fundraise cycles also. Yep. And then you've obviously been very successful at fundraising since then. How do you, at the same time, some folks are worried about wasting time with LPs who will never commit. What was your sort of? Were you worried about? Should I spend time with this LP or not? Will they convert for the next fund or not? How did you figure out which LPs you wanted to build a relationship with and which ones maybe not so much?
It's very, very hard because by definition, you never know whether they're gonna close on you until you actually are fundraising and trying to close, right? And I think that I wasted a ton of time with fund of funds. A lot of fund of funds are basically, taking 10, 12, 15 meetings with you without any, intention to invest because you just, give them a ton of data points around the industry. They learn about portfolio companies through you. They ask you who else is really good and so on and so forth. And so I just hate that. And I think over time, what I've done is, in Fund 3, I had 4 anchor LPs, and they were sort of very large for some in terms of the allocation. And what you want is ideally not to have an LP which is so large that they try and control, you a little bit, or they, they could be a huge issue if ever they were leaving, from one fund to the next. And so eventually what we've done is we've added, a bunch of institutional sort of diversifying the source of capital. So we have, a bunch of funds, but we have a bunch of endowments, we have a bunch of foundations, we have a couple of pension funds, we have 15% of our capital coming from Europe. And so we've tried to now build this LP base of about 20 institutionals, because, out of the $200 million we raised a year ago, like 195 plus is coming from institutionals, and the rest is a bunch of friends and a couple of family offices. And so we try and make sure that there's a lot of resilience in this capital, but also build relationships with a couple of new LPs every cycle, so that if ever someone has to go, wants to go, you have sort of replacement. And then, to be honest, we fired LPs too. So eventually, like, I'm really happy with the LP base we have now.
Terrific. And as your fund sizes have gone from 55 to 100, now a larger fund most recently. How do you think about sort of fund size relative to when you first started to now? Is it a similar type of company, similar stage? You're still seed, focused on seed. Can you talk a little bit about how fund size sort of determines sort of strategy?
So I think there's like the bottom-up approach and the top-down approach, right? Bottom-up is, so there's 3 partners. We, each invest in one company per quarter over 12 quarters. Our investment period is 3 years. And so we all roughly do 10 to 12 deals per cycle, right? Each of us is going to write a initial check size of $1 million plus, and we have reserves for the Series A and Series B, so call it 3 million per company, 30ish companies, 90 million plus fees and everything, 100 million. I think that it's hard to call yourself a seed fund and be over 100 million. I think this is something which has been implanted in my brain by my dear friend and largest LP, Michael Kim, who just says, look, it's 100 million is really sort of the max. And there's no reason for that, but it's something which actually sort of, I can see why. And 100 million, therefore, is the size of our seed funds. And then for the opportunity fund, which is this fund that invests in our existing companies when they raise a Series C or Series D, so much more concentrated, growth focused, larger check size. This one, the first one I raised was 50 million because I wasn't sure what was the optimal size, and I need to know what ability I would have to write kind of super pro rata type checks in Series C's and Series D's of our companies, and not have validated that with our first fund, which was 50 million. Then I decided to double it. And then what you do also is to figure out what is going to be easy to raise. Like, am I going to spend a lot of time fundraising? And because if you move from 55 to 85 to 100, 50 to 200, you need to have actual sort of LP capacity to fill those funds. And so we felt that 200 plus 100 was actually the right thing to do, and we raised those 2 funds in a ridiculously short amount of time.
Right. Congratulations on that. And a part of sort of the fund size is determined by portfolio construction, and that's determined by ownership. How has your thinking remained the same or changed around ownership, right from when you first started, where you may not have gotten the ownership you wanted, but with getting the $15 million fund and the $55 million fund, you're probably buying more and more ownership. How has sort of ownership, how do you think about ownership in general back then, even now?
Sure. And as VCs, you have to accept this cardinal rule. 4 or 5 companies will make up the vast majority of your returns for each and every fund. And so your ability to return a fund multiple times is based on your ownership in those winners that turn those winners into fund returners. Like, if all goes well, we return the entire fund on Postmates, right? And we've already returned the entire fund on Fitbit, and we've returned close to the fund on Bongo. and we'll return the fund on Postmates. So that's going to be right there, 4 companies returning the fund 4 times, right? That's the kind of math that you need. And for this to work, you need to have enough ownership. So fund 2, my goal was to get in the deals. And, it was really driven by, hey, can I write, what's the largest check I can write? 100, 150, 250, whatever. Like my first check in Fitbit from fund 2 was 125K, right? And then did a couple of, follow-ons, and we still returned the fund 3 times, I think, or 2.5 times on Fitbit. So fund 2, no ownership focus, just getting the deals. Fund 3, let's try and get 3 to 5% of the companies, right? When we invest, write a 300, 400K check, and then see how we can maintain ownership in a couple of rounds and then dilute, right? Fund 4, we started saying, hey, 7 to 10% is the target. And from fund 5 on, when we lead, we target 10 to 12, right? And so now, fund 6, if we lead the round, which we do about half of the time, or co-lead, we'll typically get 10% plus of the company. We'll try and maintain our ownership through Series A and Series B, and then we'll do the Series C and Series D if the company is really sort of performing well from the growth funds. And the inverse math hopefully will work for us, where our successes will own enough of the companies so the fund is returned whenever they exit.
One of the recent discussions in our AFM Slack channel has been modeling for portfolio, how many initial investments will make it all the way, how many follow-ons will come up, and then the reality sometimes is different, because you model some scenario and the reality is there may not be enough room even if you want to invest in a company. How do you think about sort of a sort of like a back of the envelope modeling exercise for yourself to figure out how much you want to reserve, how much you want to deploy early on, and then what are the typical things that happen in reality when you are trying to do follow-on investments?
Sure. So and it's very, very hard, and we get it wrong all the time, and we've had issues with, like, one of the hardest things to figure out with this size fund and this kind of size of portfolio is reserves, right? You always underestimate reserves, but if ever you're not underestimating reserves, you may find yourself in a situation where you have reserves you can't deploy for exactly the reason that you mentioned. And so the current rough math is we know we're going to invest in about 30 companies in a fund. We allocate about $3 million per company. So when we invest 1 million, then could be 1 million for the A and 1 million for the B. When we invest 1.5 million, we'll figure out how to slice the remaining 1.5 between the A and the B. And sometimes we'll be out of reserves once we've invested in the A and the B. And if the company is truly exceptional, we'll use the growth fund to take over the B allocation. That's our kind of secret.
I'm trying to weave in as many of the questions as I can from the 120 or so participants. One question that I think is still on top of people's mind is that if you look at the landscape today, fundraising is there are many options for folks with rolling funds out of angel list, family offices, high net worth. At the same time, it's COVID. Raising is not, you can't meet people. LPs can't meet people. What do you make of the seed stage landscape now with the number of funds, the availability of capital, but you still have to get into these deals? What would you say to the folks who are beginning this journey today?
I'm not sure I would do it, to be honest, because I don't have this issue because we're established. We have a great brand. People sort of want us involved because it means a lot to Series A firms when they see us, involved in the companies, because they know they will have been trained, right? Like the entrepreneurs will have learned a lot of things with us on the board and so on and so forth. I think I was referring to this sort of shtick, right? So you have to be very precise. Like, I'm a generalist. I will invest in, SaaS, B2B enterprise, consumer marketplaces, frontier tech. I'll do, a quantum computer deal here, and I will invest in, 3D printed diamonds there. And I can do it because I have now a track record that nobody, like people say, oh, invest in that, interesting, as opposed to what the fuck. I think that as a new manager, you want to figure out what you want to be known for. So as you get successful, people say, oh, this person is really good for this kind of deals. So figure out, what sort of shtick you want to be pushing out there, whether it's pre-seed, which is really ideation, versus seed, where the product, starts being built, whether it's a very specific set of sectors, geographies, types of founders, those kinds of things. Like you can really slice and dice the market opportunity in a number of ways. And there's nothing which is right or wrong. It's just like, what do you think you can be the best at? And then people say, oh, these guys or this guy or this gal are really sort of awesome and you should get involved. Because at the end of the day, the big decision that entrepreneurs have is who is worthy of an allocation in this next round. And it comes through recommendations that, other sort of firms or angels will sort of provide. The fact that you can write a check is no longer enough, unfortunately.